Dodd-Frank Act as a response to large bank failures, investment bank and otherwise, during the 2008 crash, created the concept of banks that are important to the system. For example, if tomorrow JP Morgan goes down and its obligations are not backed by FDIC and stuff, the the crash in U.S. economy is going to be so big, we will actually beg for the Great Depression. Because why? You know, other banks have monies loaned to JP Morgan. If JP Morgan cannot make their obligations, then Fifth Third probably won't be able to make their obligations, which means we will all be in trouble as well. I mean, as individual investors, FDIC will cover it, but more than likely that insurance fund will be bankrupt as well. So Dodd-Frank Act in 2010 created the concept of large banks that are important to the system. Let's call them the systemic banks. So if they go down, it creates a snowball effect, and it basically creates contagion. The limit to be considered a systemic bank was $50 billion in assets. So if that regulation had stayed in place, Silicon Valley Bank, similarly First Republic Bank, that went down with assets of around 100 billion, would have been in that category. The difference between a Fifth Third, which is not a systemic bank, and a systemic bank is how they're monitored. Fifth Third is the regulator is FDIC. Every 3 months, the regulator comes in, does a bank examination, writes a risk report to FDIC. If they see signs of danger, they take action. But if you're a systemic bank, somebody from your regulator sits on location. So think of JP Morgan, which obviously is a systemic bank. And I think the regulator is Fed, if I'm not mistaken. A group from Fed actually has offices in JP Morgan headquarters. And these guys look at what's going on at JP Morgan almost real time. So if they see danger, signs of danger, they could do something about it without having to wait 3 months. That's the difference. But in 2017, Trump administration said we're going to raise that limit to $250 billion. I agree there was a need to adjust that a little bit, if nothing for inflation, but going from 50 to 250 was pretty big. Obviously, that kind of regulation has a little bit of extra cost. That's why banks didn't want it. And by the way, in Silicon Valley Bank, in 2010, I don't think they had assets more than $5 billion. And within 10, 12 years, they went to over 200 billion. I mean, I had the numbers for all of this stuff. If they were a systemic bank, these issues would have been seen long before, and banking system could have done something about it. Every country has their own capital adequacy ratios, but there is also some sort of international standards, and these were pretty much agreed upon in meetings in a Swiss city called Basel, or if you pronounce it in its German, Basel. Uh, it basically said a minimum capital adequacy is going to be 8% of risk-weighted assets. Treasury bonds would not be considered risky, for example. And it divided capital into two categories: tier one core capital, which is basically the bank's own money, initial money invested plus any retained earnings, and tier two supplemental capital. These are essentially long term loans obtained by the bank. So if JP Morgan issues a 30-year bond, it is considered a tier two capital. Why? Because they don't have to pay it back quickly. But it could count more than 50% of the total bank capital and no more than 4% of risk-weighted assets. You have updates of those. You can read all of those in the book. All right. Let me see. I got about 20 minutes. Now, in terms of, let's talk about just the international money market. Then we'll finish up the chapters next time. The core of the international money market is the so-called euro currency markets. You're probably thinking, is it limited to Europe? No, it's kind of a misnomer uh, that originated in late 70s, early 80s, but it kind of stuck. In until late 70s, there was a regulation in the US. It was called Regulation H, I think. I don't remember the name. And there was a limit on, there was a ceiling on how much interest American banks could pay on deposits from US customers. So you put your money into a savings account, and your bank says, I'd like to pay you 5, but Fed tells me I cannot pay you more than 3. When inflation is relatively stable, that wasn't much of an issue. But if you know anything about 1970s, especially after 1973, uh, following the Yom Kippur War in 1973 between Syria, Egypt, and Israel, and Americans helped Israel. Otherwise, they would have been wiped out unless they used their nuclear weapons, which to this day they deny or they do not acknowledge that they have them. U.S. came in and helped them out. They won the war. As a response to this, major, especially Arab countries and some of the other OPEC members, they declared an oil embargo on U.S. and Western forces that supported uh, Israel, and oil prices went from $3 to $9 overnight. $3 in today's dollar is close to maybe, I don't know, 20. 9 is close to 60 or something like that. But, and the economy of the industry of late 70s or mid 70s, the economy is a lot more oil dependent in terms of energy compared to now. Now we have all sorts of alternatives. Nuclear energy, renewables, especially natural gas. But those days, when you had an oil shock like that, it created recessions, and it also created inflation. By 1978, the US inflation rate was over 10%. Well, I'm a wealthy individual or I'm a corporation. Think of Google. They have over $100 billion cash to invest, or cash and cash like. If Google had that kind of cash in 1970s, they would have had to get only 3% when the inflation is 10. So in real terms, you're losing money. But if you were able to do this in Europe, they don't have a regulation like that. You could have done that. Of course, as usual, finance, just like in anything, finance in financial engineering, necessity is mother of all invention, right? So banks came up with the following solution. I'm going to allow you to have deposits that are denominated in US dollars, but the actual deposit is going to be located outside of the US. And those days, it was pretty much just Europe. And these banks were called Euro banks. Those deposits were called Euro deposits, or those dollars were also called Euro dollars. That's where the name comes from. If those deposits were in Japan, but still denominated in US dollar, they still are called Euro dollar. That's where Euro currency market is. You know, the market in US dollars, but transactions are done outside of the US. So the name stuck.